Value investing. How to find undervalued stocks and make money. In 2018, Tesla stock was trading at around $350 per share, but by early 2020, 2 years later, it had skyrocketed to over $900 per share. It takes a hawk's eye to spot undervalued stocks such as Tesla's at this time and make a fortune out of it. Today, I'll present to you a range of strategies that you can use to identify undervalued stocks in the market and stay ahead of the curve by jumping on early. From analyzing financial statements to studying market trends and industry news, we'll explore various approaches to help you pick stocks that are trading below their intrinsic value. Trust me, if I had seen this video like when I had started investing, I'd have made my first million at 20. Before we jump into it, hit the subscribe button. So what do we actually mean by undervalued stocks? You see, undervalued stocks are a fascinating aspect of the financial world that many investors overlook. I like to think of it as hidden treasure waiting to be discovered by astute investors. They are stocks that are trading below their fair value and present an opportunity for investors to purchase them at a discount. One real-life example of an undervalued stock is Amazon in 2001. When the dot-com bubble burst, many technology stocks saw their values plummet. At the time, Amazon stock was trading at around $6, down from a high of $106 the previous year. Many investors had lost faith in the company, and some analysts predicted that it would go bankrupt. However, Bezos remained confident in his long-term strategy and continued to invest heavily in the company's infrastructure and expansion. Over the next few years, Amazon stock gradually recovered, and by 2007, it had surpassed its previous highs, trading at over $100 per share. Today, Amazon is one of the most valuable companies in the world, with market capitalization of approximately $1 trillion. Which leads us to the question, why do stocks become undervalued? While the reason for undervalued stocks may seem straightforward, the causes behind them are more complex and nuanced. Take, for example, the case of Apple Inc. In the early 2000s, the company was struggling and many investors had lost faith in its ability to innovate. However, the company's fundamentals were still strong, and visionary CEO Steve Jobs was working on revolutionary products such as the iPod and iPhone. Savvy investors who recognized the company's potential purchased shares of the undervalued stock at a discount. Today, Apple is one of the most valuable companies in the world, and those early investors have reaped substantial returns on their investments. Despite this success, Apple stock has experienced periods of undervaluation, most notably in 2013 when the company's share price fell by nearly 45% over 6 months. This was in part due to the concerns about slowing iPhone sales and increased competition from other tech giants. However, rather than panic and make knee-jerk decisions, Apple's management team remained committed to their long-term strategy, focusing on innovation, cost-cutting measures, and expanding into new markets. As a result, Apple's stock price eventually rebounded, reaching all-time highs in the years that followed. You see, these examples illustrate the undervaluation that's not always a straightforward matter of market fluctuations or misjudged results. Rather, it can be seen as the result of complex factors. It's safe to conclude that the undervaluation of stocks can happen for a variety of reasons, some of which are more obvious than others. More common reasons for undervaluation is change in the market. Market crashes, corrections, and other economic events can cause stock prices to plummet, often without warning. When this happens, investors may panic and sell their shares, driving the price even lower. Another cause of undervaluation is sudden bad news. Whether it's a scandal, a political upheaval, or a natural disaster, events outside of a company's control can negatively impact its stock price. When this happens, investors may overact and assume the worst, leading to a sharp decline in the company's value. Cyclical fluctuations are also a factor in undervaluations. Certain industries, such as retail or hospitality, may experience slow periods at certain times of the year, leading to lower stock prices. This is often due to seasonal trends, and savvy investors will take this into account when making their investment decisions. Finally, misjudged results can cause stocks to become undervalued. This can happen when a company fails to meet its financial targets, leading investors to lose confidence in its ability to perform. This can be due to a variety of factors, such as poor management, increased competition, or unexpected changes in the market. With this in mind now, how do you identify undervalued stocks? To understand this, you need to grasp the concept of fundamental analysis. I like to look at it as an approach that examines a company's financial statements to determine its overall intrinsic value. Ideally, we want to focus on quality stock trading at prices below their intrinsic value. In other words, it's not just about finding cheap stocks. Instead, investors must look for stocks that have solid financials, a strong track record, and good growth prospects, trading at a discount to their fair value. So let's look at the 5 most important metrics to consider when picking the best undervalued stocks to invest in. I like to look at these metrics combined as a signal to pick undervalued stocks, where I can put my money with minimal risk. You can find these metrics on Yahoo Finance. Number 1, the price to earnings ratio, PE. The PE ratio is a widely used metric among investors, but it should be used with caution. A low PE ratio could indicate an undervalued stock, but it could also mean that the company is experiencing financial difficulties or is in a declining industry. Conversely, a high PE ratio does not necessarily mean that a stock is undervalued, as it could be a result of strong growth prospects for the company. For example, let's compare the PE ratios of 2 companies in the same industry, Company A and Company B. Company A has a PE ratio of 10, while Company B has a PE ratio of 25. At first glance, Company A may seem like a better investment since it has a lower PE. However, further analysis shows that Company B has a higher growth rate and stronger earnings potential than Company A, which justifies the higher PE ratio. Typically, we want to look beyond just the PE ratio and consider other factors, such as the company's financial health, management team, and industry trends. Additionally, comparing a company's PE ratio to that of its peer industry can provide valuable insight into whether the company is undervalued or overvalued. Number 2, debt-equity ratio, DE. I like to use the DE ratio to evaluate a company's financial health. This ratio helps me to understand how much a company relies on borrowed funds and how much is invested by its shareholders. A higher DE ratio can indicate that a company has a higher level of debt than equity, which may make it riskier for investors. For example, let's say that Company A has a DE ratio of 1.5, which means that it has 1.5 in debt for every $1 in shareholder equity. If Company B, which is in the same industry as Company A, has a DE ratio of 1.0, it means that Company B has $1 in debt for every $1 in shareholder equity. This suggests that Company B is less reliant on debt than Company A and therefore may be a safer investment option. However, take note that a higher DE ratio doesn't mean that a company is a bad investment. In some industries, such as utilities or telecommunications, it's common for companies to have higher DE ratios due to the nature of their business. For example, a utility company may need to take on more debt to finance its infrastructure and expansion projects. Number 3, return on equity, ROE. The ROE is an important metric used by investors to evaluate a company's profitability and efficiency. However, keep in mind that a high ROE does not necessarily mean that a company is undervalued. It could simply mean that a company is utilizing its equity efficiently to generate profits. For example, let's consider 2 companies in the same industry, again, Company A and Company B. Company A has an ROE of 15%, while Company B has an ROE of 25%. At first impression, it may seem like Company B is undervalued and a better investment opportunity. However, upon closer inspection, you could discover that Company B has a much higher level of debt compared to Company A, which is why it's generating a higher return on equity. In this case, Company A may actually be a better investment opportunity as it has a lower risk profile. Remember that ROE can also vary significantly across different industries. For instance, a technology company may have a higher ROE compared to a utility company, as the former tend to have a higher profit margin and require less investment in fixed assets. Therefore, you need to compare a company to a company's ROE within its industry peers to determine whether it's undervalued or not. Number 4, dividend yield. A high dividend yield is an indicator of an undervalued stock. You see, companies that pay consistent and high dividends are often considered more attractive, especially for investors who seek steady returns on their investments. For example, Johnson & Johnson, J&J, a multinational pharmaceutical company, is known for paying consistent and high dividends. In 2021 alone, the company paid $4.04 per share in dividends, with its current share price of around $170. This means that the dividend yield for J&J was about 2.38%. Another example is Procter & Gamble, PG, a consumer goods company that's been paying dividends for over 130 years. In 2021, the company paid out $3.16 per share in dividends, with a current price of around $135. This means that the dividend yield for PG was about 2.34%. In conclusion, while ROE is an important metric, no doubt there, it should be evaluated in conjunction with other factors such as debt levels, industry norms, and future growth prospects to determine whether a company's shares are undervalued. Number 5. Current ratio. The current ratio is a crucial metric for businesses as it reflects their liquidity position and their ability to meet short-term obligations. A ratio above 1 indicates that the company has more assets than liabilities, which means it's more capable of paying off its debts. A ratio below 1 implies that the company may not be able to meet its financial obligations. For example, let's consider a startup company that is in the early stages of growth. The company may have high debt levels due to its investments in research and development, marketing, and other expenses. In this case, a current ratio below 1 may not necessarily be a red flag because the company is still in its early stages and is expected to generate revenue in the future. However, if the current ratio remains below 1 for an extended period of time, it may suggest that the company is struggling to manage its debt levels and generate high enough cash flow to cover its expenses. Furthermore, industries may also have different current ratio benchmarks. For example, a software company may have a higher current ratio than a manufacturing company. This is because software companies often have fewer physical assets and lower inventory levels, which means they require less working capital to operate. In contrast, manufacturing companies require large amounts of working capital to manage inventory levels and production cost. If you guys want to be successful in investing in undervalued stocks, you must keep in mind that it's a long-term strategy that requires patience and discipline. While the market can be volatile, quality stocks will eventually rise in value over time and provide a decent return on investment. However, take note that investing in undervalued stocks is as risky as any other form of investing, and you must do your due diligence before making an investment decisions. I'm happy to answer your questions in the comments section. Hit me up. If you found this video helpful, please smash that like button and subscribe. See you in the next ones. Cheers.